The stock market rose on its last trading day of the year, but still fell for the year a considerable amount. It's actually the worst year since the financial crisis. This just happens to coincide with the year of central banks contracting their money supply, but let's pretend that's not the case and this is just a coincidence. I will distract myself with fake unemployment numbers, fake GDP numbers, and why not fake inflation numbers while I'm at it. Ignorance is truly bliss, isn't it? You came here for the truth, so let me unveil that for you. Today we're going to look at what has happened throughout 2018. I'm going to give you a breakdown of a very wild year. There have been many geopolitical issues, many economic issues, many factors that have played into what had unfolded throughout 2018. And so I want to cover what occurred today on the last trading day of 2018 and then show you over the last month, 3 months, and all of the year as well. There's a lot to get into. I'm going to give you a lot of charts, some articles as well. So let's begin by taking a look at the markets. You're looking at the US markets, the top 3 on the right hand side, S&P, NASDAQ, and the Dow Jones, all in positive territory for today. If you look at the 1 month chart on the left hand side, you could see what occurred throughout December. It is still down quite a bit, but towards the end of the year, we saw it come up. And I need to be clear as to why this occurred. I did several videos about the pension fund's $64 billion secret. If you haven't watched those already, you have to definitely watch it. Essentially, what I get into is how the pension funds moved a large sum of money from fixed income into equities and needed to do that in the last few trading sessions of the year. In doing so, that pushed a lot of money in, that triggered the algorithms, that got the buy the dip type investors to put their money in, and so we have some level of return to where it was at previous to December, but it was still down in November and down in October as well. So the market has not looked good despite this little increase that we've seen in the last few trading sessions. What the market needs right now is a promise from the Federal Reserve that there will be no increase. The sad part for those investors looking to put more money in or who are already overburdened by the amount that they currently have are facing headwinds throughout 2019 if the stock market starts to rise further, because the Federal Reserve is going to look at it and say, we don't have any issues here. We're just going to continue our program of 3 hikes in 2019, and then the market's going to sink as a result. The trade issues between the US and China are obviously very important, so we need to follow that as well on the geopolitical level. That's probably one of the bigger factors on the geopolitical terms that we're seeing, but how that ties into the economy is obviously very direct. But there are some new factors at hand, and that is the AIIB, the currency swaps with China, how they are developing new alliances that go deep in development with various countries. I think it's really big news what's happening now, but it's going to take a while for that to actually unfold. It's not going to happen next year. They may fix this turmoil they have with the United States, and the market will love that. So we're going to see where that all unfolds over the next couple months. Wild December for the Dow. This is the daily performance of the Dow in all of the trading days, and you could see the worst day of the month was nearly 800 points, and the best day of the month was about 1,000 points into the positive. There are more red days than green days, that's for sure, but I just wanted to give you this because it just gives you a visual of how this looks. Now, I wanted to give you some more details. Wall Street concluded a tumultuous 2018 on Monday as the major stock indexes posted their worst yearly performances since the financial crisis. All right, so you're looking at the S&P and the Dow Jones were down 6.2% and 5.6%. 2018 was not a good year for either of these indexes. The tech-heavy NASDAQ was down 3.9% in 2018 as well. Its worst year in a decade when it dropped 40%. So obviously, this is nowhere near the levels we saw during the financial crisis. But understand where the peak was and where the bottom was. You know that these markets fell into a bear market briefly. That turned around, obviously, but it's important to see where the peak was and how far it has come down. The stock market's epic fourth quarter reversal is one for the history books. For the first time ever, the S&P 500 will end the year with a loss after being positive for the first 3 quarters. So that's an interesting and unique year, 2018. This doesn't happen, and this is one that will have to turn around very quickly in January unless this is going to be the next recession. Now I have several charts to get into, and you are looking at the world index right here, down into correction territory. This is the worst year since 2008 for world stocks. You need to look at not just the United States, you need to look all over the world. You can see the indexes of the world stocks, but also individual countries. And I will show that to you in a moment. But as I said, this is the worst since then. And this chart here happens to go back to 2003. This is the most important factor, and that is the central bank assets. Okay, they continuously expand their assets. And as you can see on this chart, this is the first contraction. This chart goes back to 2002, and this is the first contraction that they've had. They've been holding on to assets for a long time, but since 2008 they rapidly expanded the amount they had. But this is the first time they're actually letting go. That's very, very important, and I don't see the media ever covering it to this degree. I don't see the alternative news pointing at it, and I wonder why I'm the one yelling and screaming and saying, why isn't anybody factoring in the central bank assets at this level? It makes complete sense that they are entirely correlated. Global systemically important banks have fallen 36%. This is huge. As you see here, looking at global stocks falling, this happens to be the systemically important banks, the too big to fail banks. From top to bottom, it dropped 36%. Now for the year, it's down 27%, and you're seeing a complete reversal from 2017, which was 20% into the positive. This chart goes back to 2012, but it's worse than all of these years. Of course, once again, the worst since the financial crisis. I have 2 charts to show you. Essentially, we're seeing a comparison of the US dollar, the 30-year, gold, and the S&P on the year as a whole, as well as December. So you're seeing that the US dollar has been this year's possibly best investment for many. That has been the one that has actually returned some level of income. It's been a messy year, no doubt, when you look at this on all levels. If I take this chart here, you're seeing December and the S&P falling dramatically, and gold and the 30-year happens to be into the positive territory as people shift their priorities and start to look elsewhere into investments. They're looking for safe havens. They're looking for ways to unload from their growth stocks and put money into where they believe is safe. China also had a very bad year. You can see the Shanghai Composite going back to levels that haven't been seen since 2014. It's incredible to see how far it has fallen. Now, we can look at this on 2 different levels, whether we are seeing the peak experienced in early 2018, the market has come down approximately 30% since then, or from the peak in 2015, and the market has come down 50% from that point. Either way, it's not good. 30%, 50%, you take your pick. And this is just showing a comparison of the Chinese markets, looking at all of them down this year. All right, they were battling up and down and sideways and everywhere, but the general trend has been down. The Shanghai Composite, 25% this year, and from its peak, down about 30%. Looking at the other markets, the Shenzhen Composite 33%. I mean, it's terrible on so many different levels. The tech stocks have been beaten down brutally. And it's not just in China. We saw this happening in the United States as well, from their peak coming down quite a bit. Now, if we look at their performance from the bottom of the financial crisis up until today, look, we're getting some good performance on that, but a lot of people were buying the dip throughout 2017 and they're not doing well in many cases. Depends on the stock, of course, depends on the index. It depends on many factors. Then you look at European equities, Italy and Germany as two examples that have really taken a beating, with Germany requiring exports, but they are suffering on many levels because of what's happening all around them. Italy has had so many problems in 2018 as well. There are very few bright points coming out of this market right now, unfortunately, for those who have put a lot of money into this. So that's really all I wanted to get into today, just to break down the details of what occurred throughout 2018. I have been very methodical in breaking it down and documenting the process as it happens. I have tried to be as informative as possible. I've tried to give all the details that I possibly can because I know how important it is to get the real data. What's going to happen in 2019? Well, it's anybody's guess. However, I do believe that what we are encountering today is really just the tip of the iceberg for what will be experienced, because as the central banks continue their policy of quantitative tightening, that's going to have a negative impact, and the more they take off, the worse it's going to be. So if they were to just take off, let's just say $36 billion a month like the Federal Reserve is doing, it doesn't have as much of an impact as when they get to 50 billion, when they get to 80 billion. And so if they do continue that policy as they have promised, then it's going to continue to get worse and worse. The market cannot be sustained without central bank quantitative easing. That is a simple matter of fact. If you found this video informative, please give me a thumbs up. If you give me a thumbs up, you're supporting this channel. So that's what I ask you to do. You don't have to do anything else. Just give me a thumbs up, and that's all I need. If you want to comment on the video, if you want to be one of the subscribers here, we are just about to hit 170,000 subscribers very shortly. So I want you to be one of those people. So hit that button and you will be notified of the videos I do every single day. If you want the financial education you were not taught in school, these two books have everything that you need. They cover all the issues from the foundation and the history all the way up to making money, tax incentives, and so much more. So check that out at the link in the description. If you want the audiobook version, you can get that at themoneygps.com.